Have you ever seen a market that just seems to break all the rules? Well, we're diving into one today. In the world of uranium, something truly bizarre is happening. Demand is soaring, supply is collapsing, but the price is actually falling. It's a paradox that on paper shouldn't even be possible. So we're going to figure out what on earth is going on.
So check this out. This is the heart of the mystery, what we're calling the impossible triangle. You've got supply shrinking, you've got demand growing, and at the same time, prices are dropping. Now, in any other market you can think of, it's impossible, right? Scarcity plus high demand always equals higher prices. It's economics 101. But not here. In the weird world of uranium, all three are happening at once.
Right. So the big question here is, how on earth can this make any sense? Is the market just fundamentally broken? Or is there something else going on right below the surface that most people aren't seeing? Let's start digging.
Okay, first up, let's build the case against the price. We're going to look at the hard data, the fundamental clues about supply and demand that the market's price action seems to be completely, and I mean completely, ignoring.
Clue number one is a massive supply shock. Cameco, one of the biggest and most important uranium producers in the world, has come out and said they expect to fall short by up to 20 million pounds this year. That's not a small miss. That is a giant hole blown in the side of global supply.
So supply is tanking. What's happening on the other side of the equation? Well, clue number two, demand is absolutely exploding. In the single month of November, buyers signed contracts for over 31 million pounds of uranium. We're talking about utilities and major funds frantically locking in future supply.
And this is where it gets really weird. The most baffling clue of them all. In that exact same month, while supply was cratering and demand was surging, the spot price for uranium didn't go up. It didn't even stay flat. It fell by 7.5%. This is the point where all economic logic just goes right out the window.
This chart just puts it all together visually. Look at that red line up top. That's the price, and it's trending down. But then look below it. You see the production shortfall getting worse and worse. And then that enormous bar at the bottom, that's the demand explosion we just talked about. The data is telling three completely different stories, all at the exact same time. And make no mistake, this isn't just one company having a bad year. We're talking about the two titans of this industry, Cameco and Kazatomprom. They are the biggest producers on the entire planet, and they have both gone on record saying they are struggling. Kazatomprom is literally dipping into its own savings account, its own inventory, just to meet the orders it already has. The supply crisis is real, and it is global.
So if the price signal is totally unreliable, where else can we look for the truth? Well, let's do what investigators do. Let's follow the smart money, because the actions of a key insider are telling a very, very different story. And this quote right here just nails it. It perfectly captures the mindset of the Sprott Physical Uranium Trust. These guys run the world's largest physical uranium fund, and their position is crystal clear. The price you see on the screen, it's not real. It doesn't reflect what's actually happening in the physical market. And you know what? They're not just talking. They are betting billions of dollars on it.
Just look at what they were doing in November. This wasn't some random one-off purchase. They were buying systematically, day after day, week after week, even as the price kept falling. This is not what panic looks like. This is what conviction looks like. It's a calculated campaign to get their hands on as much physical material as they can, while the market is giving them what they believe is a discount.
And this visualizes their whole strategy perfectly. See that red line? That's the spot price, dropping through the floor in November. But while that's happening, look at the green bars. That's Sprott's physical stockpile, and it's getting bigger and bigger and bigger. They are aggressively buying the dip because they believe the dip is a mirage.
And the sheer scale of this bet is just enormous. In November alone, they snapped up over 500,000 pounds. Their total hoard is now over 74 million pounds. That's a fourfold increase in just 4 years. This isn't some small player speculating. This is one of the biggest fish in the pond, betting everything that the price is dead wrong. So how is this even possible? How can a market get so disconnected from physical reality? Well, the answer lies in the unique and, let's be honest, kind of strange structure of the uranium market itself.
See, unlike oil or gold, there's no big, public, transparent exchange for uranium. The spot price that gets reported everywhere isn't set by thousands of trades happening out in the open. No, it's determined by a few consultants based on a tiny handful of private deals. It's an opaque system, dominated by a few players, where most of the action happens behind closed doors. It's a market that is almost built to get disconnected from reality.
And whenever you see a strange situation like this, you have to ask that classic investigator's question: cui bono? Who benefits? Who actually gains an advantage when the official price is low, even when the real physical market is screaming tight?
Well, there's a whole list. First, you've got the utilities, the companies that actually need this stuff to power our cities. Obviously, they want to sign new contracts at the lowest possible price. Then you have financial players who are short selling, literally betting that the price will go down. And as we just saw, you have strategic funds that can use a low reported price to quietly build a massive physical stockpile. There are some very powerful interests who are happy to see a low paper price.
Which brings us right to the final, crucial choice for anyone watching this market. It all boils down to one central question. What do you trust? The price on the screen or the fundamental data from the real world? And this slide just lays out the dilemma perfectly. You've got two completely conflicting signals. The price signal is telling you, hey, this market is weak, there's plenty of supply. But the fundamental signal, the actual data from producers and buyers, is screaming, this market is incredibly tight and desperately undersupplied. You simply cannot believe both at the same time. So, this whole mystery leaves us with some really tough, unanswered questions. I mean, if the world's biggest producers are short, who in the world is doing the selling that's pushing the price down? And maybe the most important question of all, how long can this bizarre disconnect between the paper price and physical reality actually last before something has to give?
Because here's the thing, in the long run, history shows us that with physical commodities, reality always wins. You can't print more uranium. You can't create it out of thin air with some fancy financial instrument. If there physically isn't enough stuff to go around, eventually, the price has to catch up to that reality.
What we're watching right now is a head-on collision between a financial signal and physical reality. The question is no longer if something is going to break. The only question is what breaks first.